Europe's gas storage just hit its lowest level since 2011, right as Hormuz shut down. Yet the euro isn't crashing the way old playbooks predict. That's because oil shocks don't hit every currency the same way anymore. One pair is absorbing almost all the pressure. Stick with me. By the end, you'll know exactly which currency is most exposed and how traders are actually framing the trade. Record US crude output, record LNG exports, and fuel shipments just cushion the world after Hormuz effectively shut down. In the 1970s and 90s, oil spikes hurt America's current account and weakened the dollar. Today, the US is a net energy exporter. Higher oil prices now bring in export revenue instead of just pain at the pump. USD, CAD looks like the clean trade. Canada exports oil too, so the loonie should be rallying hard. But it isn't. Traders are pricing US resilience higher than Canadian upside, capping CAD gains even as WTI climbs. The euro faces the opposite problem. Europe imports the overwhelming majority of its energy. Every headline confirming Hormuz stays shut adds euro downside against a dollar that's partially insulated at home. Japan and India carry the same vulnerability. India sources roughly 90% of its oil from outside its borders. The reveal is still ahead, including exactly how this trade could be sized. Domestic US inventories are falling below 5-year averages, even as exports hit records. Gasoline and diesel prices are up nearly $1 since before the war. America exports stability, but imports inflation risk. The Brazilian real and Mexican peso benefit from sustained high crude. The Turkish lira and Indian rupee sit on the losing side. Here's the real risk. Middle distillate inventories are now 12% below their 5-year average. One hurricane, one refinery outage, and the buffer that's cushioning oil prices could crack fast. If that buffer breaks, this whole narrative flips into a stagflation scare, and that's historically dollar negative. The currency most exposed here is the euro. Its structural energy deficit makes it the cleanest loser in this setup. The approach traders use is fading extreme USD downside once gas fears are fully priced in, not chasing every headline. The caveat matters most. If US inventories crack, dollar resilience itself could reverse just as fast. Read the full analysis on edge-forex.com. Link is in the description.